Welcome back. You're watching Crystal Ball, and I've been in a very engaging discussion with Manish Chokhani, Director of Enam Holdings. There have been these asset quality scares coming in even from the private banks. There's a lurking suspicion that disclosures have not been what they actually should have been. And not just small banks. Public sector has been in the doldrums for a while. The two largest private banks, two of the larger private banks are down 30-35% from their peak values. Does it worry you that you could still have disclosures which people do not expect, and it could maybe even lead to contraction in valuations even further from where we are now?
So I don't think at the end of economic cycle one should worry excessively now about assets getting even worse from here, because end of the day there still are strong balance sheet and there still is a strong government. But the point is actually well taken that the asset quality wasn't great. The fact is absolutely right that the disclosure or the way things were disclosed was not right, and that certainly does not make a case for saying your valuation multiple should get re-rated. And therefore now you have to start proving the case over the next 2, 3, 4 quarters that you're actually not as bad as the market fears you are, and you're much better than what they think you are. And that's really the heart of the problem, as I'm saying, that the composition of the index is such that it's very hard now to pick, maybe a Reliance or someone has to pick up the leadership, and hopefully Jio or something, becomes a new kind of leadership sector in India and recreates the whole media, telecom, consumption, all of that space, and starts providing some leadership to market. But otherwise it's very hard for a market to go up without weight of earnings now supporting it.
What about the other leader sector? Since you spoke about leadership, and that indeed is the problem for this market. Banking, despite its problems, is still 1/3 of the index. And then you come to pharmaceuticals, which has been such a leader sector. And then you have these accidents cropping up. Sun Pharma down 40% from peak,
Yeah,
Dr. Reddy's
that's right.
a howler one day. That sector too is such a wealth creator, but people are rattled there as well. How would you approach it?
Yeah. That's right. So it's, like I said, if you think of it as the classic phase 5 when leadership narrows and then those leadership stocks start crumbling, that really marks the final climax when people just give up and say, I can't take this anymore. And then you go through a lull period. So I'm hoping that's not the case, because all these seem to be one-offs. But there are just so many one-offs aggregating and creating trouble for fund managers in India as well as overseas, that you start thinking, really, do I need to take all this pain, or am I just better off being outside for a while? Or like a lot of people have done in India, that you just go in mid-caps and hide out over there because there is no seller over there, because there is no large holder over there, and then you can start creating positive alpha there. But that again is not, like I said, a sustainable way to take the sort of whole market and the whole sentiment up. So you're absolutely right. Also, when I look across at IT, in the 2000 period when there was such a frenzy with Y2K and all these dot-coms coming around, and the period right now is eerily reminiscent of that, where all these new technology companies are coming, get it funded, becoming unicorns and so on. This time around, it's not that the Indian IT services people are benefiting from that sense of urgency or that demand, because a lot of it has now migrated to cloud, and the Amazons and Googles of the world are virtually offering these services on tap. Or with the use of machine learning and robotics and AI, the usability of that whole software code has become easier. And therefore you're seeing these high quality companies now also languishing, sub 15 PE stocks on a 1-year forward basis. And again, it's hard to make a case that why these should get re-rated and go back to a 20-25 multiple. So I confess, absolutely, while I'd like to sound a lot more bullish than I probably am, the reality is it's very hard to make a case right now for this market to lift off.
What about the downside, Manish? Because that's another refrain that you hear, that the market's in a holding phase right now. It's stuck in a range because it does not have the profit cycle support, and therefore it will spend more time grinding in a range. But the downside is restricted. The market won't see price cuts. 75, 7700 on the Nifty is the bottom. You won't get too much lower than that. Do you agree with that hypothesis, or that too is wishful thinking and just being hopeful?
No, I think unless there is a major accident elsewhere in the world, it's hard to make a case for India to fall, because the fact is we still do have unit volume growth. We are still, an island of positivity in the whole world, which, like I said, is deflationary. You can't make that case for India. You will still see double-digit, volume growth over here across most sectors. The issue has been profit growth because there has been overcapacity or intense competition. And as we start creating that level of capacity utilization, and you get some level of what I call manufacturing inflation as opposed to agricultural or commodity inflation, you start seeing then the profit cycle coming back. So I agree with you that I don't think this market falls or sells off dramatically, because at particular levels there is enough appetite in the rest of the world as well to come and buy India, and evidence of that is, like I said, in the private equity domain as well. It's been compounded, I think, last year, which I don't think a lot of people realize, that when oil falls to $40, it's a double-edged sword, because all these countries which were profiting from oil, their sovereign wealth funds actually started seeing shrinkage. And then if they start redeeming their money out, and at the same time you start getting calls that commodities and BRICS are now over, and you get the retail ETF selling. So you get sovereign fund as well as ETF selling at the same time, and that culminates in this kind of massive sell-off. Also, we compounded it by the fact that we got debt funds into India this year to play the whole interest cycle arbitrage, and that money is now in the process of going back when they're seeing US rates going back, and the currency tumbles. So it just becomes a self-fulfilling downward spiral. But like I said, I hope we are approaching the climax of that. So we're probably bottoming out in that sense. But for this market to go up, I think it will take, more, like you said, the right term is grinding it out to start getting the earning recovery. Before you see, one segment has to open up where it looks like a very easy profit opportunity, and then the whole world jumps and comes aboard.
How do you approach asset allocation at a time like this, Manish? Because a lot of people were torn between fixed income and equity this year because of the rate cuts. You could get 10-11% from fixed income funds as well. Is there a outright case for equity for the domestic investor, or do you think it's still a tricky call, close call?
So, well, at heart I'm an equity person, so I'm always going to say that, while you may play one interest rate cycle down, the point when you get that whole interest rate cut, you have an asset reallocation problem at that point, because where do you put the money at that point? And at that point, it's more than likely that equities would have already run away. So, in my mind, equity is always a 3-5 year sort of forward discounting story. And in a 3-5 year horizon, it's always almost certain that equities will outperform, because the underlying rate of return on equity for all the companies that represent India and the index is 15 to 20%, let's say, give or take, depending on what you're picking. There are obviously better quality companies there. But on debt, if your starting base is, let's say, 8%, and then the rates go down by, say, 100 or 200 basis points, you're starting to allocate away from a 6% yielding asset into a 18% yielding asset, whose prices by then would have already run up. So I would still say the right allocation to make in India still is equities. As Indians, we are underinvested in equities. And while the world is murky, we are certainly, like the phrase in India, the Ando mein Kana Raja, that the government balance sheet is actually not in bad shape. Corporate balance sheets, despite the 5 or 6 big headline cases we hear about, is not really in bad shape. The domestic investor in India is actually in great shape. We don't have a lot of borrowing, whether it's for housing or for personal consumption. So it's a matter of time before the cycle turns, and I think the trick over there is stopping this unrelenting fall in our currency, because what's happened over last 5 years, I've seen, for example, auto sales going flat, consumption sales going flat, and then the shift from rural Narega-led consumption to now urban-led consumption, but basically being flat, is because per capita income in India basically stagnated. And if only we can get our whole country focused on getting our per capita income up from whatever $1,800 to $3,000 and then eventually $5,000, and galvanize people to get skilled around that. That is the final, cause for a fundamental bull market. And again, like I said, it's not going to happen in 1 year, but at least the government of the day is seized of the problem and pointing in the right direction to try and get that done. And other than that, like in India, you always sort of look up to heaven and pray that things fall in place.
My last question, Manish, is a tricky one. If I were to ask you, for the next 3-4 years, for a patient long-term investor, does it make sense at this stage to stay with the leaders of the previous run, things like maybe banks, private banks, pharmaceuticals, some autos, or does it make sense at this stage, if you can hold out for 3-4 years, to look at the bombed out sectors which people do not want to own? Metals with all its problems but at great valuations, real estate which nobody wants to touch, and infrastructure which the poster boy L&T has let down and therefore is not looking so attractive. Which basket would you be more comfortable with as a patient investor?
Udayan, I think given where the macro playing field is today, and given how badly these other bombed out sectors, as you refer, are looking for bounces, they are not structurally going to be wealth creators for you. So if you're looking to sit tight, actually the best businesses, and it's no accident the indices over time tend to hover around 65-70%, tends to be in consumption, pharmaceuticals, TMT, and banking stocks. Auto, I'm including in the consumption basket. This is by and large 75% of a good portfolio. It's by and large been 75% of the index composition over 20 years. There are bouts when commodities go crazy, but they are called commodities for a reason. And typically the previous cycle, which was commodity led and BRICS led, tends to go through 10-12 years of pain following that. So you look back at history of the Japanese bull market of 87, peaked and then it takes 20 years to come back. The Nasdaq bull market peaks in 2000 and it takes 15 years to come back. So it's not that these are going to come back in a big hurry and provide leadership. So I would tend to still stay, given where bulk of India is, look at that 75-80% of the index as a good place to be. And no one yet is showing signs of becoming such a leader that they will overturn the existing leadership in all these spaces. So I think the index is not terribly priced, it's not overvalued or anything. It's a question of the earnings coming through, and like I said, the return on equity for all these companies is in the range of 18-20%, and that's a good enough place to be, because surely at some point valuations will re-rate upwards from here. So just be patient and hold on to the faith, and that's really what I'm doing as well.
Manish Chokhani, always a pleasure to hear your perspective. Thank you very much for taking time out today.
Thank you.